All right, welcome to today's episode of Money Watch Weekly. And of course, today we look at the state of the Zambian economy. We've not had that sort of review since the year started. I'm privileged to have Mutsunge Zulu, who is Chief Risk Officer at Zanaco. And of course, I have Dean Onyambo, who is Head of Trading at First Capital Bank. Both banks doing quite well. FCB starting a new putting up a new building to be ready in about 14 months, environmental friendly, a green building. And of course, Zanaco still bragging about that 1 billion kwacha profit after tax. Interesting from the two gentlemen. But otherwise, thank you for joining me, guys, this evening, or to this Money Watch.
Thank you.
Good to have you.
Good to be here.
Yeah. So let's start off with a general overview of the state of the economy right now in Zambia. What would you say is the current state? I'll start with you, Mutisunde.
Thanks, Joella, and good evening, viewers. So I'd say, if you allow me to, I'd like to look at the state of the global economy because Zambia is
part of the global village.
Exactly. So I think there are very interesting themes that are dictating the environment. I think there's geopolitical tension. Russia, Ukraine are causing commodity prices such as crude to hit close to $96 a barrel, right. And that becomes a source of concern. It affects us because then we are net importers. Then it means that our price reviews are pointing to potential hikes. The second one is inflation. The world is grappling with inflation. There's excessive inflation. Where did it come from? Injections from global central banks that we're trying to cushion pandemic-induced credit risks, and because of that, we're seeing the West hit 7.5%, and that's what is necessitating discussions around the Fed having to hike rates, and we should expect a very strong dollar. Yeah. COVID hasn't, completely phased out, and it's still in the supply chains, much as, yes, there's vaccines and the world is reopening. That's another driver of commodity prices going up because everybody is trying to claw back lost growth that they, from the pandemic period. Right. And I guess the other one is just technology. I mean, the pandemic has actually accelerated the digital shift. Everybody is talking about 5G, artificial intelligence, machine learning, and they say there's two things that you don't want to be left out on is technology and the rapture. So you really have to up your game if you want to remain competitive. So, and then coming back to Zambia, I think clearly we are in the labyrinth of debt restructure. I think there was that excitement last year when the staff mission reached an agreement with the MinFin around the 1.4 billion. But I guess something that probably Dean would speak about is that the markets are nervous. Yeah. I mean, we've had that goalpost shifted almost 3 times. The first time we expected first quarter disbursement from a roadmap that was shared by on that presentation to bilateral creditors, and then it moved to May, and then it moved to June. We've got maturities coming up, and markets don't lie. We are viewing markets as indicators. Markets are telling us something that players are pretty much uncomfortable, and that might cause jitteriness. So there's that debt discussion. If you look at the rains, yes, they delayed. There was that damage to crops. We might not push that much in terms of production in the year. Well, at the same time, price reviews that have come up, fuel prices every month will get new. It's as though there's predictability in cash flows. Now we can tell with precision whether prices are going to go up or not. And then lastly, I would say there's this debate around interest rate outlook. Yes, the curve did come down significantly, but the question we are also asking ourselves is in the last 10 to 13 weeks, we've seen yields start to tick upwards, though the bond auction did show us a flat outcome this time. So are we expecting any further hikes and that? So it's mixed feelings, mixed signals that we're picking here and there, but I think there's never been a time in history that we've seen this interrelatedness of variables. We thought that what would be happening in the West would never affect us, but we're actually seeing it right now. So in a nutshell, I guess. That's from your position. And Dean, you have anything to say with regards to the state of the economy?
Yeah, well, I think Mutsunge's pretty much covered everything. Yeah. Just with regards to the global environment, Look, you've got your geopolitical tensions with regards to, Ukraine as well as Russia.
Yeah.
I think one that doesn't really get much traction with regards to the news cycle is there's also bubbling under, which is the China-Taiwan one. In terms of what the Fed is going to do, look, I think the larger probability is that the Fed is going to be forced to slam the brakes hard because inflation is going to be elevated for a long period of time. And because of that, that's why the market, parts of the market has 6 to 7 hikes, expecting 150 basis points to 175 basis points. My question is, what if the Fed has to do more?
Yeah.
Is the market really prepared for that? In terms of, locally, we estimate growth last year was 3.9% year on year. But we think a large part of that growth, 70% to be exact, was because you had activity coming back. You had fewer lockdowns, 2021 compared to 2020. 70% of that growth was numerical.
Yeah.
So growth is still very fragile. I think that statement came out very clear with regards to the monetary policy statement. And because growth is so feeble, it seems like despite the fact that we had some moves to try and boost private sector activity, it feels like even in 2022, we're in a position where we're still depending on public investment to actually drive GDP growth. Sure. Private sector continues to be in a very fragile place. You had the PMI going from 51.5 to 49.9. And I know a lot of respondents attributed that to the COVID pandemic.
Right.
But if you actually look at the COVID stringency index, it's not like we had stricter lockdowns.
Yeah.
So I'm not sure we can really blame that reduction in private sector activity purely to COVID. I think a function of it is coming through from a reduction or an impact on consumer aggregate demand based on the fact that inflation continues to be very elevated. And for me, that's a bit of a concern as to why we haven't seen direction with regards to the central bank hiking the policy rate. I know they're worried about growth, but for me, I'm a little bit worried about inflation expectations and anchoring those. But I guess we'll discuss that a bit later.
Yeah.
But just generally, I think growth is still fragile in Zambia, particularly from a private sector place. I think while the government's looking at possibly getting 4.4% GDP growth by 2024, we think that we'll only get to about 4% in 2026. So still wary of the impact of elevated inflation on consumer aggregate demand and the feed into private sector activity, as well as the impact that we have at the moment from parts of, moments in time where we have dollar illiquidity issues, which does feed into elongating supply chains for local corporates. Interesting.
Now, even as we still look at Zambia in totality, the S&P raised Zambia's local currency rating to CCC plus from CCC minus.
Yeah.
What led to that adjustment, and why didn't they also look at the foreign currency side in terms of the rating, which is twin selective default? Maybe you can go ahead.
Yeah, sure. So on the local currency side, I think we can be clear on that in the sense that we do not expect the government to default. We don't expect the restructuring is going to include local debt. Yeah. And I think if you also read the feedback from the S&P, they will upgrade further should it be very clear that local debt will not be restructured. Of course, there is still a bit of an issue with regards to the arrears, but it's very clear the domestic arrears is going to be cleared over a multi-year period. But generally, the improvement in that outlook for the local debt position, as well as the local fiscus, is because you had your fiscal deficit at about, it was at 8.7% 2019, went to 14.2% 2020. This year looks at around 9.6%. And then if you look at the medium-term framework, we're looking at 6.7% this year. We're looking at 6.3% next year, and around 5.2% 2024. So the trajectory of the fiscus, local debt, that's why you had that upgrade. The reason why we haven't had the external debt upgraded is because the debt structuring is still in a bit of I'd say, a limbo. Muchisunga has already touched on goalposts being shifted. Yeah. I think we'll get through the line with regards to the IMF deal. The question is, when are we going to get debt restructuring done? We think partial debt restructuring could be completed by Q2 this year. Think overall debt restructuring by Q3. But it's starting to feel a bit ambitious. And the reason for that is, last time I was here, I mentioned that your non-Paris lenders, predominantly your Chinese, unwilling to take haircuts. Unwilling to take haircuts, if you look at the way they've gone about their restructuring across the world, they haven't done that. They don't want to set a precedent where you have a domino effect of other countries where they've lent out into, wanting to also get a haircut. So you've got two possible scenarios here. Is it that our bondholders, or Euro bondholders, will have to accept an equal treatment in the sense that they'll get a haircut while the Chinese lenders will not get a haircut? If that's the case, then that's a restructuring which is sort of outside the common framework, because the common framework is about equal treatment. The second piece is, will the government maybe have to accept that maybe no haircuts will come from any of the creditors? And if that's the case, then it becomes a question of how do we get back to debt sustainability? And the only way we can do that is by reprofiling that debt over a longer maturity period, which means that it will take even much longer to actually pay down our external debt.
Right, interesting. Anything to add, Mutsunga?
Okay, so I think from my end is I've always learned that any country is AAA rated for its own paper.
Yeah.
So you expect to see a little bit of reprieve on the local currency side. But like I always echo in some of my interviews is that until debt is restructured, the foreign currency will never move. It will still remain in selective default mode. I'm a little worried, just to add on to what Dean has said, the fundamentals are shifting. Rates could be going up globally. So the question is, the haircut discussion, the restructure discussion, at what rates is it going to be? Because the first time that the discussion was had, rates were at a particular level, but the fundamentals are changing. So even bondholders are alive to whatever is going on in the external environment. And the shifting of goalposts as well doesn't make it any better. But I think one level of comfort is that if you look at the 2022 budget, it's as though the 750 million that falls due in September was budgeted for. So the question is, should we get to June and closer to September before debt restructure? The question is, will the central bank still be able to foot the bullet payment? Is that the reason why we've seen dollars coming in, but them not being sold? Are they keeping a stock of dollars for a rainy day? So that's a possibility, so as to be able to meet that bullet payment. Okay, this is a scenario that we are running, but that would be at the expense of selling dollars on the open market. So meaning the currency might be under pressure between now and then. I like
that you mentioned currency, because post-election we saw that that strengthening of the kwacha, which towards the end of the year it kind of held on, and then as we crossed into the new year, kwacha weekend, January, and coming into February, what led to that? And obviously, by what you're saying, the Bank of Zambia stayed away from the market until last week when they moved in and sold.
But you see, the interesting thing about the Zambian economy is that a lot of people proxy growth for currency appreciation. You can understand that when political risk subsided with a shift in government, okay, there was it coincided with the state of the global economy where interest rates were ultra thin and there was excess liquidity, and players then shifted their liquidity into emerging and frontier markets that were offering higher yields even in dollar terms. But well, at the same time, when this economy is growing, it means demand for imports is up. So there's so many pressure points. There's things that people don't talk about in this market, such as coupon payments, because the stock of offshore players are now holding more of our government securities. And what that means is that coupons will fall due back to back. And when those coupons fall due, that money has to be repatriated, and that's demand for FX. So, and then petroleum at the same time, agricultural inputs. So we seem to have a number of factors that add on to pressure on the currency, and the only way we can stabilize that currency is the central bank dipping into its reserves. But then remember, there is the same portion for reserves is the same portion of stock that we are keeping, that the country is keeping for a potential payment when September comes. So it's like Dean said, we're still not yet out of the woods, and it's as though markets are screaming to say, you are a net importer, and for the longest of time, if you want to see your currency pretty much stabilize, we need to start thinking about boosting our export base.
Interesting.
Just, I mean, I just want to add to that. Well, you know, it's very interesting. pre that dollarization of mining taxes, the central bank was actually a net buyer of dollars from the FX market.
Yeah.
They have now become a net seller of dollars, and the main reason for that is, look, 70% of our export earnings, as Mochisunge says, talking about the diversification, is linked to the mining sector. Those dollars are going straight into the central bank. Muji is talking about that $750 million that we need to pay in September, but we're already in default. What have we considered? What the chances are that, since we're already in default, if we don't have debt restructuring by then, we just continue being in default. We may not need to make that payment. But, if we do need to make that payment and we want to make that payment, it's not just that $750 million that's maturing, because I don't think we can make that payment without clearing a portion of the external arrears. You already have, as at the end of December, $2.2 billion that we owe our external creditors.
Right.
I think the central bank is being prudent. I mentioned that the last time I was here, in the sense that maybe they're selling a bit less so that they can cushion the reserves and, try to have that dollars maybe for that payment,
of course,
maybe for the external arrears.
Yeah.
But, for as long as the debt restructuring is not completed, then we should expect that probably if the central bank continues with its prudence, then they're not going to be as aggressive in their dollar selling as they were last year.
Yeah.
Which means, as Muti rightly said, that the currency could continue being under pressure.
Yeah.
But they seem to sort of have changed the tactic. They are intervening a little bit more frequently, as we have seen from last week. And maybe that's with regards to anchoring expectation of a further depreciation,
right,
so that you don't have that spike that we started seeing towards the end of January and the beginning of February, where we had that massive depreciation. So maybe they're trying to protect that a bit. If they continue to do that, then it might change the outlook. But if they don't, our outlook, for example, for dollar kwacha at the end of March is at around 19.4.
Okay, we will take a quick break right now. Then, of course, when we come back, we'll look at some of the risks that are out there on the horizon. You're still watching Money Watch. All right, welcome back to Money Watch Weekly. Today's episode, we're looking at the state of the Zambian economy. In quarter one, we've got Mutsunge Zulu from Zanaco. He's the Chief Risk Officer. And we've got Dean Onyambu, who is Head of Trading at First Capital Bank. And we move on and come down to some of the specifics right here in Zambia. Now, the ERB, despite rising, despite crude prices rising in the most of January, they came up with a reduction of palm prices, of course, based on December figures, both FX and the market, the crude market then. With this new simple pricing model that they've taken up, do you think it's effective? And what sort of impact do you see it having to both businesses and individuals, especially from an inflationary point of view? Who goes deep?
No, sure. It's something that Muti also mentioned at the start, I guess, when he mentioned about predictability, budgeting, because you're basing the review of the prices on the previous trajectory of the international oil price as well as the dollar kwacha. You know what's coming. So, not to dump in the mood for our viewers, but, the 6% reduction that we had at the end of January, at the end of February, based on the trajectory of the dollar kwacha price as well as the international oil price, does look like the ARB is going to adjust local fuel pump prices at least 12%, maybe as much as 18%. So it's good.
Based on the January numbers?
Yes, that's based on the January, the move in January for dollar kwacha as well as international oil price. So, it's good for predictability. I like it because we know what's coming.
Is a monthly review good, or why not quarterly review?
Well, I think you've got to be more realistic and more timely with regards to these adjustments, so that you don't compromise anyone who's part of that supply chain. Okay,
Mutsunge, what is your outlook on petroleum now that we're talking about crude and just the power sector in Zambia?
Okay, maybe the petroleum has been tackled by Dean. Of course, it's something that, like I did mention in the beginning, we're talking about geopolitical tension, which is pushing the price of crude and the predictability that comes in. And sometimes it's not every time that when you have an appreciation in the kwacha that fuel prices are going to come down. I think it's The formula is very clear. It's two variables. It's rent prices plus your exchange rate, and if it exceeds that 2.5%, then there's an adjustment. But maybe let me talk about electricity.
Yeah.
So I think electricity for Zambia has been a very interesting topic. I think because of climate change effects, if I look at the Kariba Dam levels, they're still about 23%. Still lower than where they were a year ago. That's not looking too good, because that in terms of energy generation, hydro could be much of a problem. So we could be looking at potential load management.
Yeah.
To what extent, not very clear. But at the same time, you have policies. There's a lot of things that are the policy reform going on in that sector as well. There's that discussion around cost-reflective tariffs, and with the subsidy steps, the scrapping off of subsidies, you expect that tariffs would actually be hiked, and if they do go up, it's inflationary, and it increases the burden on individuals, and the cost of living does go up. There are some positives that have actually happened, where the bulk supply agreement discussion between CEC and ZESCO has started.
Yeah.
That's a positive in itself. So I'd say it's mixed feelings, but I think the biggest elephant in the room has been, what are optimal and cost-reflective tariffs? I mean, you have a cost of service study whose outcome has been kicked down the road for the second time, and everybody is very keen on what the outcome would be to save the power utility. That is actually very, very critical. And at a time when copper prices are actually high, there is that motivation to increase production, but an increase in production means greater demand for energy, but at what prices, that becomes very, very critical. So if you ask me about what the energy outlook would be, I would say it's positive for some and negative for other players. And at the same time, there's this strong decarbonization drive. So renewable energy as well, there's that opportunity, especially that it's an area that is also pushing the demand for copper up, because they say renewable energy would demand, is it 8 times more copper for wiring. So energy is still fragile, but I think to get to the point that we need to start attracting the right investment, we need to sort out the pricing. We have not yet gotten it right in terms of investment. So I think that those would be my views. I don't know, Dean, what you
No,
have
I
to
think
say about the
you're
energy.
spot on. You need to sort out the pricing. Also, I think you touched on regulation. You also need to have a conclusive end to, the regulatory space where you are protecting private sector investment. That's going to be crucial for attracting that foreign direct investment. You've spoken about renewable energy, and I keep saying it. Zambia has been identified by the World Bank as one of the countries with high solar potential. When we talk about hydro, Zambia has 40% of the water resources in SADC. This massive, massive potential. The question is our attitude. The question is, in terms of policy, consistency of policy. Those are the factors that you need to attract sustainable investment. In terms of, electricity, yes, we've seen positive direction, but I want to see quicker direction in terms of, are we going to see an increase in pricing for the mining sector? Because, you've got long-standing contracts there. Are those going to be broken? If they're not going to be broken because you have that long-standing contract, you can't break it, then we have to bear the full brunt of that. Mining consumes 50% of electricity in the country. If the rest of us have to bear the full brunt, and you're talking about moving into a direction, maybe if you look at, the average cost of electricity in the region, ours are 40% cheaper. If you have to double ours, it's 80%, hike in electricity. The good thing that I can say, a lot of the removal of these subsidies, yes, it's about helping the fiscus, but it's also about helping the fiscus under an IMF deal, because this is what the IMF spoke about. The good thing with the IMF is that they will give us some time. I think, yes, the cost of service study has been kicked down the road, and I can maybe see that electricity prices may not be adjusted higher, possibly up until the end of the year, maybe even at the beginning of next year.
Interesting. Now, just 2 weeks ago, the MPC sat and obviously maintained policy rate at 9%, which was against what most experts were forecasting. What do you think led to the central bank maintaining that, and how do you see their behavior towards the next MPC as they sit? Mutsunge?
Thank you, Owela. So, well, judging from the governor's remarks
yeah.
and the MPC communique was really hinged on a declining inflation trajectory, though arguably I'd say I still attribute that to base effects. And yeah, and then the central bank was very clear that it still remains wary of upside risks to inflation because there's two factors here. There's endogenous and exogenous factors. I think endogenous, we've already talked about the base effects and all that, but then the exogenous factors in the light of Zambia being a net importer. Supply chains are still bearing the brunt of autopsy effects of COVID. Today, if you had to make any payment and get supplies from out there, you will actually pay $50 more than what you would have paid.
Yeah.
And that already is importing inflation. Food prices. The Food Agricultural Organization Index has actually shown that food prices last year were up 40% because of supply disruptions there. Yes. And then the interesting thing is if you look at soft commodities such as soya, prices have actually gone up because China is demanding so much soya. So when your commodity prices do go up like that, it provides an opportunity for farmers that want to export and take advantage of that price. But for local farmers, they're crying because the price of feed is actually going up. Beef prices have actually gone up because of foot and mouth disease. So on the food side, if you look at exogenous factors and how they trickle in, it's as though upside risks to inflation are very high. And then talking about what we were just talking about, the US Fed. Should the Fed hike rates, it will mean a strong dollar. A strong dollar means by default, emerging market currencies take a beating and they weaken. And one of the emerging and frontier market currencies is the kwacha. So then the currency will still be under pressure. And if the kwacha starts to depreciate, then we expect cost push inflationary effects. And then that's puts pressure on the central bank. But we do understand that the central bank has to balance up between growth that this economy has to claw back, especially that it was clawed back by not only COVID, but by frail fiscals. So I know that it was a difficult one for the central bank to balance out. It's as though if purely this was left to just fundamentals without thinking about growth, then would have expected tightening of rates. But there's that argument around how far will inflation, continue to trickle down before it starts to push upwards. And then you've also got the fuel component with this predictability that we're talking about. So if fuel prices, we're talking about crude that's $96 a barrel, which is definitely pointing to fuel price bears. And if fuel starts to tick upwards, cost of production will go up. It's still inflationary. So inflation is really going to be under pressure according to our focus.
The central bank, the question you can ask, and maybe this is, perspective also from the central bank side, if the inflation is cost push, what will a hike do? Right? It would be easier if a hike, if your inflation was caused by demand pull. So if you hike, you peg back by demand. But if you hike now and the inflation is cost push, will it really bring down the inflation rate? So that's one angle to look at it. But I agree with Moti. For me, this is where my concern is. Yes, I understand growth is fragile. But if you look at the main reason inflation is coming down, it's because of base effects. It's mathematical. It's unwinding base effects. Unwinding base effects are prevailing over increase in fuel prices. They are prevailing over all the other adjustments that will be pushing inflation up, including a weaker currency. If you look at inflation last year, first half, 2.2% month on month. Decade average, much lower than that. So inflation is unusually high. So you'd expect that unwinding base effects have an effect this half of the year in 2022. But those reverse in the second half of the year. So that's why even though we think inflation is moving lower, possibly to around 10% in June, we still think it's going to edge back higher towards the end of the year. Why? Because the base effects will turn negative with regards to pushing inflation higher. For me, what I'm concerned about is anchoring inflation expectations. The reason why you still have a lot of speculative buying of dollars, or even dollar earners holding onto dollars, which is, I'd call that still speculative, is because they still expect the kwacha to be weaker than the dollar. That's still an inflation mindset. in the sense that they expect that the dollar will stay stronger than the kwacha. And I think even though the inflation of the hike from the central bank may not have that direct effect with regards to impacting cost push inflation,
Right.
but I think it could have had a strong effect, a signal hike in terms of anchoring inflation expectations and limiting that speculative purchasing of dollars. I guess one way that they may be trying to do that is by the intervention that they've been doing now with regards to intervening daily in the market, maybe $5 million here and there, to try and anchor the exchange rate so that you don't have that speculative purchasing. That may help, but I think that a signal might have also helped. For me, I'm also concerned that should we also have those upside inflationary factors that Mutisunga is talking about, like we've had the drought. Is it going to mean we have expensive food prices? He's talked about soybean meal internationally. We've got exporters locally. That's going to filter into the feed price. Right. The price of that internationally is back to $448 per ton. It was under $350 at the end of October. So that's going to affect your meat prices, your fish prices, your chicken prices. If all these factors are gearing up for the second half of the year, and we don't conclude our debt restructuring as well in time, which is going to affect the currency, you've got all these confluence of factors that are going to push up inflation, and we might actually find that the central bank is behind the curve, like we keep talking about the Fed being behind the curve.
Yeah, interesting. We'll take another short break, and then when we come back, of course, we'll look at more detail with regards to the staff level agreement and Zambia's debt restructure program. Stay tuned. All right, welcome back. And if you just joined us, it's Money Watch Weekly here at Spring TV. And today we're looking at the state of the Zambian economy in Q1 of 2022. Of course, I have Mr. Mutisunga Zulu, who is the Chief Risk Officer at Zanaco, and Dean Onyambo, the Head of Trading at First Capital Bank. So getting into my next question, gentlemen, with regards to the staff level agreement, I know as we started, we spoke about it briefly, but into more detail. We got into this SLA with the IMF, but it's pending board approval at the IMF level. Now, do we know when this approval will come through, and knowing its significance to the debt restructure for the country? Do we know when this is coming? Because, and then I also want to ask, can discussions with our lenders happen without this approval from IMF? Or we have to get the IMF approval first?
Well, I'd say an IMF deal is precursor to successful debt restructure. I think the first time that bondholders were engaged, it was very clear that they needed to see some form of surety, and that some form of surety was through the IMF. So that is why when those goalposts that we speak about are being shifted, it makes the market nervous, because then in the absence of clarity, then clearly it then throws the restructure discussion. And one other thing that I just wanted to mention is if you look at Zambia's debt profile, it's as though you actually see the posture of geopolitical tension, because you've got one area that's looking at the West and the other one is looking at China. And Chinese are very tight-lipped about how they do a lot of things, and they will not openly say what they do agree to, and that has been the biggest contention, to say, is there ever going to be consensus between the two to allow for discussions to actually go? So if you ask me about when exactly this will happen, the MINFIN know best, because like I said, at first it was the end of March, and then secondly it was in May, and then the most recent was around June, and then that's not pretty much very definite, but markets react to information. It's the value of perfect information. Whatever information you give the market is what it reacts to. So you have a lot of players that could be on the fence wanting to invest in Zambia, But because that goalpost keeps being shifted, the question is, why should they bring their liquidity to Zambia? Maybe they should go to Kenya. Maybe they should go to Nigeria and come back when there's pretty much a little bit of certainty. So it becomes very, very critical. But one positive that we can bag is after that staff level agreement, and as we await for the IMF board, when I was reading the Standard & Poor's rating for Zambia, the detailed note, it actually said that there was something to do with sustainability of Zambia's debt position for the IMF to approve that at board level.
Exactly.
So the question is Zambia's debt sustainable? Maybe what's holding the IMF is that Zambia's debt is not yet sustainable.
Exactly.
So until we get to a point where debt is sustainable, should we be so certain about seeing that deal then come through?
Who determines the sustainability of the debt deal of Zambia's debt?
I mean, there's a whole analysis behind it, but which is the whole debt sustainability analysis. It's very interesting. Look, let's give our Ministry of Finance some time. I'll say why, because one of the interesting comments I had from a good friend of mine who's a top economist, she said, the problem with the common framework is that there's no framework, because it's something new. It's not a coincidence that we're not the only ones who've had trouble with it. There was also Ethiopia as well. Yeah. So it's something new. The whole question about which needs to come first, I think it's it was a bit chicken and egg, but I think it's pretty clear, as Muchisungi said. IMF deal, precursor. I'd say it this way: staff level agreement, precursor to start the debt restructuring agreement. Yeah. You get some commitments from your creditors, go back to the IMF board, get the IMF deal. When we come back to, I don't think it's something new that the Chinese were going to play hardball with regards to not taking haircuts. We knew that. They haven't done that anywhere else. Yeah. They don't want to set that precedent. We spoke about it. So obviously the IMF knew this. Obviously the bondholders knew this. So I wouldn't be surprised, in my opinion, that if we do get some partial restructuring, or at least some commitments from the other creditors outside of the Chinese, we still get ahead with regards to crossing the line with the IMF at board level. And maybe even crossing the line with the Chinese may take a little bit longer than we all anticipate. Yeah. Which is why I said, at the beginning of the show that, still looking at partial restructuring Q2, overall restructuring Q3. If it becomes a problem in terms of the agreement between the creditors, I think that's a very bearish situation for us to be in. And I think under such a scenario, you're probably looking at the kwacha going back to those 22, 23 levels. But base scenario, I think we do cross the line with regards to the Chinese lenders. But I said, it comes back to the two things, right? Will our Eurobond holders accept an equal treatment? I'm not certain that they will. I think it may come back to us accepting that our debt is reprofiled over a longer maturity period, so that we actually get back into debt sustainability.
Right. Now, I know the Ministry of
something? Sorry. I just wanted to mention one thing, and Dean and I usually have these conversations by the side, and we're saying, why would China accept haircuts when it's got its own issues? China's got that property market issue.
Exactly.
And
Evergrande.
They've got internally, they've got bigger issues that they are trying to cushion. And I think for them, that is priority than anything that's happening on the external market. So that's another reason why haircuts could be a mirage coming from the Chinese.
From the Chinese side.
Yeah. But I think they've shown that trend even before they had the Evergrande issue.
So I was going to ask, the Ministry of Finance at the end of last year actually presented a roadmap to debt restructure. Yeah. And like you've said, they've shifted. By March, they were anticipating we'll get the board approval, and then by June have some MOUs signed with our lenders. But obviously those posts have shifted. Is it feasible to reach any sort of position with those, irrespective of what's happening, by the time the Eurobond is due in September? If not, are we able to pay our Eurobond by September? And if we are, what mechanisms do you think they are putting together?
I mean, if you follow the statement or the position that we've taken, with regards to equal treatment, I don't think that would allow us, if we stick to that position, to actually pay back the Eurobond. I think it would mean that we possibly continue to be in default up until we've reached an agreement with everyone, if we're going to stick to that position of equal treatment for all creditors.
What are the repercussions should we not pay 750 in September?
I actually, look, in terms of, let's talk about it, in terms of the sovereign rating, I don't think there's a change there. We're still in selective default. The bigger question for me is, if we are unable to pay that, right, and we haven't sorted out our debt restructuring, and we haven't gotten the IMF deal, every investment that we have seen, or not every, but a majority of the investment that we saw, particularly last year from offshore investors into our government securities, was on the premise that we were going to get an IMF deal and at least some part of the restructuring done. So you're going to have a potential escalation in divestment risk at a point where you also have significant global risks rising. And that's going to have an impact, a more significant impact on interest rates, beyond the fact that you already have upside pressure from the borrowing commitments from the government. And it's going to have upside pressure on dollar kwacha. So, look, it's one of those tough situations where I think which is why I come back to that, I think we may have to concede that we may not get haircuts from everyone for this to cross the line. And it just becomes about reprofiling that debt over a longer period of time to make it more sustainable.
Yeah, okay. Any views on that?
I was just going to add, and that's what I call asset sell-off pressure. Yeah. When, if rates are going to go up in the West, whatever maturities will come up, there will not be any reinvestments, and that monies would have to leave the country. But one thing that we can also give a pat on the back, say the Ministry of Finance, is I think that despite being in the labyrinth of all this, there has been that level of commitment, and there has been transparency. I don't think that in the history of this country we've ever seen this level of transparency. We've also seen a greater use of what I would call economic policy diplomacy. I think most of those trips that we've seen the authorities take are really speaking towards trade, and trade is one area that we haven't done so well in a very long time, and we've seen that aggressive push. Just look at this Brussels AU-EU engagement.
Summit,
look at the COP26. It's like every trip that the authorities do take is really taken advantage of to maximize that level of benefits. So there is that cognizance that, look, there are these fiscal risks, but what can we do on the other side to balance up, because we still need to be able to stand on our own 2 feet. Life has to continue. This economy has to grow by hook or crook. There is that taking advantage of mining, for example. Much as, yes, you've got this frail and fragile portion of the economy, but you still got your mining still booming. You still got your policies that have been adjusted and have made it more attractive to bring investment in Zambia. So much as there are all those risks, just look at DRC, for example. I mean, you would think that it's politically unstable, but you still have investment going there. Exactly. And I think we are well positioned for this electric car era, and prices are actually in our favor. So the question that we may want to ask as well is, how can we use mining, for example, to address some of the fiscal challenges that we have? It might not be the easiest question to answer, but there is some opportunity there that,
And it's interesting, you sound like you almost answering my final question. I wanted to ask you generally, what is your outlook economically for Zambia? And I'll shorten the period, not the whole of 2022, but let's take it for the next quarter, starting starting March, April, going to the end of quarter 2. both economic and risk.
Look, to some point, I'd say risk appetite has clawed back into this market.
Yeah.
There are sectors that were dead. So let's put the default rating aside. Okay, Zambia still is
Ready for business.
exactly.
Yeah.
So mining number one. Okay, so some of the projects that have gone to stage 2. Okay, and with that change in the mining tax regime, it's become more attractive. There's more interest in Zambia and DRC, okay, in the mining sector. And when your mining sector starts to tick upwards in terms of production, with that forecast of 3 million metric tons, demand for energy goes up.
Yeah.
Downstream business does go up. Mining needs gloves. They need to eat.
So there's
you need
value chain is, yeah.
exactly, the
So
value
value
chain is there. So I'd say those are aspects that are keeping this economy resilient despite all the negatives.
Yeah.
If you look at agri, for example, I know it hasn't rained that much, but there is this greater diversification of crops, export opportunities,
Yep.
and one or two areas. If you look at manufacturing as well, there's that push. If you look at the budget in itself, it was as well as a private sector budget to open up this economy, to stimulate growth. I think the government did forgo a number of taxes
Yeah.
for the sake of trying to allow entities to claw back the growth that they lost. So not all hope is gone. And look at it this way. If you owe money and then you increase your earning capacity, what you owe then becomes dwarfed to some extent.
Yep.
So I'd say, look, there could be risks. Yes, there's cautious optimism, much as, yes, we would be talking about an IMF deal, but what can we do for ourselves? Look at the green agenda. I think more and more players are waking up to the fact that, you know what,
There's
green
potential.
fund, there's potential for renewable energy, smart projects.
Yeah.
A number of banks are already taking up these initiatives. So the capital markets is gearing up as
Is
well.
it something
to be
Zanaco is
able,
doing? Planning on doing?
well, yes.
Or
I mean,
FCB?
there's that Kukula Capital Managed Fund.
Yeah.
So you can actually see that players are now becoming more innovative in their structuring and in their thinking to say, we can't always depend on sovereign-related issues. We also still need to navigate intelligently and contribute somehow. So I'd say, with cautious optimism, I'm still upbeat and bullish about Zambia's economic recovery. I mean, if you just look at the bond auctions, for example, much as, yes, there's all these risks, but there are people that are taking long positions on Zambia. People are buying 10-year bonds. I mean, what does that show you? It shows you that there's some people that are still optimistic, and I'm one of them.
Of course. Dean, in a minute, what is your outlook?
A minute?
Yeah, make it 1.5 minutes.
Look, Moti's spoken about the key sectors. Mining, agri, manufacturing. You didn't touch on energy. Energy as well is pretty key.
Yeah.
In terms of, look, I know, you know, IMF deal is a big thing. I know what we're doing on the side is to attract foreign direct investment, which had been trending lower for a long period of time, and I think it's important. But going forward, you know, the great hope that I have is I think we're at a place where we're going to have consistent policy.
Yeah.
And I think consistency of policy is going to be the key fundamental factor, as well as macroeconomic stability, to attracting sustainable foreign direct investment. In terms of the investment into government bonds, the reality of the matter is we need to sort out our fiscal space, and that, no matter what we say, needs the IMF. Of course. I don't think we're going to do without the IMF. Without an IMF deal, it's going to erode a lot of the investment that we've seen. Yes, we are seeing investment coming into Zambia with regards to maturities being rolled over by your foreign investors. But you're not seeing any new investment because I think there are still some people on the sidelines waiting to see that debt restructuring process being concluded. The reason why it's important for us to conclude that, as well as continue with this path that we've seen in trying to attract foreign direct investment, is I think it's going to drive a longer-term fundamental move lower in the kwacha.
Right.
And that's going to be beneficial to everyone.
Okay. Dean Mutsunge, thank you so much for coming to today's Money Watch. It's very insightful, and I'm sure I'll have you back soon with a bit more detail on some specifics. Thank you so much.
Thank you, and thanks for hosting us.
All right. That was Money Watch Weekly again here at Spring TV. My name is Yarela Chomba. We had Dean and Mutsunge. Dean Onyambo from FCB, First Capital Bank, and of course Mutsunge Zulu from Zanaco, and the Chief Risk Officer there. Dean is Head of Trading. My name is Yarela Chomba. Thank you for watching, and if you've been following, I'm sure you'll still look out for this on YouTube. We'll throw it on the YouTube channel for Spring TV, but of course you'll see the repeat of this again on Topstar and on Facebook. Otherwise, have a good evening.